A beautiful cabin with a mountain view can still be a terrible investment. Before you fall in love with the property or trust a projected revenue number, there are 5 numbers you need to understand. Miss one of them, and a property that looks profitable online could leave you feeding it money every month. I'm Lisa Stepp. I've spent more than 24 years in the mortgage industry, and I help investors finance short-term rental properties. Today, I'm breaking down the 5 numbers I review before helping a client move forward with a property. When investors send me a potential property, they usually begin with the purchase price and projected rental income. Those numbers matter, but they don't tell the entire story. We need to know whether the property can realistically produce enough income to cover its expenses, qualify for the intended financing, and still accomplish the investor's goal. Let's walk through the 5 numbers. The first number is the property's realistic gross rental income. The important word is realistic. A seller may provide an impressive revenue history, a property manager may offer a projection, an online rental data platform may produce another estimate. These numbers can all be different. Ask, was the property professionally managed? Was it available for rent throughout the year? Did it have unusually strong amenities? Was the income based on actual performance or only a projection? You should also compare the property with similar rentals, not simply every rental in the market. A 5-bedroom cabin with an indoor pool should not be evaluated the same way as a basic 5-bedroom cabin without those amenities. Rental income is our starting point, but it should never be accepted without context. The second number is the property's total operating expenses. This is where many projections become overly optimistic. You need to consider property taxes, insurance, utilities, internet, cleaning, repairs, maintenance, property management, platform fees, supplies, pest control, lawn care, pool or hot tub maintenance, and replacement reserves. You may also have homeowners association fees or permit expenses. A property can generate substantial gross revenue and still produce disappointing cash flow if its operating costs are high. Insurance deserves special attention. Never assume the current owner's insurance premium will automatically be available to you. Request an insurance quote before you remove your important contract protections. The third number is your estimated monthly housing payment. That includes principal, interest, property taxes, insurance, and any homeowners association dues. Your payment will depend on more than the purchase price. It can change based on your down payment, interest rate, loan structure, credit profile, reserves, and the type of property you're purchasing. This is why I don't like evaluating an investment with a generic online mortgage calculator. We need numbers based on your actual financing scenario. The lowest advertised rate is not automatically the best option either. Paying additional points may reduce the rate, but we still need to calculate how long it will take to recover that upfront cost. The fourth number is the debt service coverage ratio, commonly called the DSCR. In simple terms, it compares the property's qualifying rental income with its required housing payment. For example, if the qualifying monthly rental income is $6,000 and the applicable housing payment is $5,000, the ratio would be 1.20. That means the qualifying income is 120% of the housing payment. Different loan programs and lenders may calculate this differently. Some may use a long-term market rent figure. Others may consider eligible short-term rental data or an appraisal-supported analysis. A property's true cash flow and its qualifying DSCR are not necessarily the same thing. That distinction is critical. The property could look profitable in your personal spreadsheet but fail to qualify under a particular lender's guidelines, or it could qualify for financing while producing less spendable cash flow than you expected. We have to evaluate both. The fifth number is your estimated cash-on-cash return. This compares your projected annual cash flow with the total cash you invested. Your investment includes more than your down payment. It can include closing costs, lender costs, inspections, appraisal fees, initial repairs, furnishings, supplies, reserves, and money spent preparing the property for guests. Suppose you invest $150,000 in total and expect $15,000 in annual cash flow. That would represent an estimated 10% cash-on-cash return. But that projection is only useful if the income and expense assumptions are realistic. I also recommend stress testing the property. What happens if revenue is 10% lower than projected? What happens if insurance costs more than expected? What happens if the property needs a major repair during the first year? If the deal only works under perfect conditions, it may not be the right deal. Here's the complete picture. First, determine realistic rental income. Second, identify the true operating expenses. Third, calculate the expected housing payments. Fourth, confirm how the lender will calculate the DSCR. Fifth, estimate your cash-on-cash return using all of the money you'll invest. A property doesn't have to be perfect, but you should understand its strengths, weaknesses, and potential risks before making a major financial commitment. Your goal isn't simply to buy a short-term rental. Your goal is to buy one that fits your strategy, your financial capacity, and your long-term plan. If you're evaluating a short-term rental property, send me the address, purchase price, and any available rental projections. I'll help you review the financing side of the deal before you move forward. Visit lisastep.com and select Review My Deal, or send me a direct message with the words Deal Review. Subscribe to the channel for practical short-term rental financing information, real deal breakdowns, and strategies that can help you become a more informed investor. I'm Lisa Stepp, powered by Empire Financial. I'll see you in the next video.